Hiya, this is Thinking Solo. I'm Ryan DeRusso, a fee-only financial planner. Today, we're going to talk about a tricky decision for those seeing their practices grow or expand, selecting the right retirement plan. It's not an easy decision since it's one that is connected to the way you grow, the vision you have for your business, and what you expect it to be in the future. It's also a decision that will impact the amount you can save for longer term goals, whether that's retirement, financial independence, or even saving on taxes. The two main tools that those in private practice use to save for long term goals are the solo 401k or the SEP IRA. Let's break down the two tools and the differences to better help you understand how they can and cannot help you. Let's get started. When looking at the solo 401k versus the SEP IRA, you have to realize that they differ in how they function. This difference exists because they serve different purposes. One, the solo 401k maximizes. The other, the SEP, incentivizes. Let me explain. So the maximizer, or the solo 401k, is meant for those that have a private practice and no employees other than yourself. This gives you both the employer and employee a way to maximize your savings up to $66,000 without paying anyone else. The incentivizer, or SEP, doesn't just work for those in solo practice. It can be used for those with employees as an incentivization tool. But unlike the solo 401k that allows for a significant contribution based on make, the SEP IRA limits the contribution to 25% of the self-employment income up to $66,000. On top of that, if you do have employees, then whatever percent you give yourself in terms of contributions, you also have to give it to every eligible employee in the plan. Because in a SEP, the employer, i.e., you, provides all the contributions to the plan. This controls how much you're saving, both for yourself and your employees. But in a business, it incentivizes employees to stay. Now let's talk more deeply about why a solo or independent 401k can maximize your savings potential. In a solo 401k, you're treated as both the employer and the employee. Like any employee, you can contribute up to $22,500 a year in 2023 into the plan. This money does not get taxed until you withdraw funds, and it can grow to huge numbers over time. But like any employee, the employer has the option to add more contributions to the mix. While most employers will add a small match, so say 3%, they actually can do that up to $66,000 for 2023. Of course, the $66,000 when combining employee and employer contributions. Most employees do not get anywhere near that amount from their employer, but you're your own employer. This gives you the opportunity to add up to an additional $43,500 into the account if you're maxing out your employee contributions. That's a huge amount that you can grow without worrying about ongoing taxes until the year you withdraw. And if you're over 50, you have access to catch up contributions as an employee as well. That's maximization. In one important way, the SEP is like the solo 401k in that the max contributions you can make in 1 year is $66,000. How you get to that level, however, is dramatically different. Remember, the SEP incentivizes. So if you have employees, it's a way to incentivize. Unlike a regular 401k, the employee does not contribute to the account. Instead, all contributions come from you, the employer. Here's the rub. Whatever percent you give yourself, you also must give your employees. So if you're contributing 20% of your income to your own SEP account, then you must give 20% of your employees' income to a SEP. This may be fine if you have one or two employees with lower pay that you want to keep happy, incentivized. But as the business grows, this can not only limit what you save for yourself, but also can impact the bottom line. Luckily, whatever you supply your employees with, you can treat it as a tax deduction for the business. The value of the SEP is that it's fairly simple to set up, and you don't have to contribute anything in some years where the business doesn't perform as well. Again, it's about incentivization. But there's one more wrinkle to this. Since you are maxed out on contributions at 25% of net income, this can limit how much you can give yourself. Essentially, this 25% number is your income after you account for deductions for self-employment taxes. This results in a back of a napkin calculation of about 20% of income that comes in. So if you make $100,000 this year, the max contribution is approximately $20,000. If you make $200,000, then it's about $40,000. This is limiting your ability to save if you're trying to maximize your efforts. Based on this information, you're probably thinking that you should only consider the solo 401k, but it's not that easy. First, if you hope to build a business with full-time employees, eventually you will have to shift towards something other than a solo. It's only offered to one-person businesses. Second, if you have a full-time job and operate a side gig, the SEP can allow you to max out your employer-provided 401k while adding contributions from your side gig to the SEP. It's valuable. But if you're wanting to keep your business solo, you want to one day consider a backdoor Roth or Roth conversion, which I'll save for another video, or you simply want to maximize your savings, then the solo 401k does make a lot of sense. What do you use for your financial independence or retirement savings? Why? And let me know in the comments. This is Thinking Solo. Make sure to like and subscribe, and I'll see you next time.